Good evening, Canada. Welcome back to the final edition of Investor's Guide to Thriving for 2020. Well, this year has seemed both very, very long and incredibly quick all at the same time. It's really hard to believe when the year began we had venues and flights booked for doing these shows live across Canada. Yeah, it's hard to remember a time when things seemed normal and we were concerned about the market actually being overvalued. Today, the market standing at all-time highs seems almost self-justified. But the real question is, when is normal coming back? I mean, maybe that's whenever the next time we get 400 seniors to come out to hear Larry speak at the local Cineplex. I wonder still, will most of us have taken the vaccine by September like Mr. Trudeau expects? Will all the stimulus mean that corporate earnings will be gangbusters right through the second half of 2021 and into 2022? And what social change will result from the extreme distortions this has caused in our economy and society at large? Well, tonight, Larry will take a shot at these tough questions and also introduce his new market probability indicator, the PRO-II. Of course, you can still catch Larry on BNN, on his official Larry Berman YouTube channel, and online at bermanscall.com until we see you here again on Investor's Guide to Thriving when the series resumes in March 2021. So Larry and I would like to take a moment to thank those of you who have joined us in Investor's Guide to Thriving in support of childhood leukemia research at Sick Kids and Alzheimer's and dementia research at the Baycrest Foundation. If you'd still like to make a donation, please use the links in the survey you'll receive after the event. That's how we're able to track and match your donations. That survey is also your gateway to access the webinar replay. It'll arrive in your email tomorrow morning. We'd love it if you could take a minute to let us know how we've done. If you haven't filled in the survey and you have been tuning into the webinar these past 10 weeks, we would love to hear from you. I know there's other ways to get you can watch, you don't get the slides, but you can watch the actual video on the YouTube channel. But do me a favor, take a second, do the survey, let us know what you thought of the online format this year, what we could do to make it better next year. We'll be listening. Your feedback really matters, so thank you so much. Well, Investor's Guide to Thriving is brought to you through a lot of hard work, love, holiday spirit, and let's not forget sponsorship. Big thanks go out to our excellent partners, BMO ETFs and National Bank Direct Brokerage. This week, NBDB is going to give you an overview of their state-of-the-art self-directed investor platform, including all the tools, watch lists, and alerts you can harness to track markets in your portfolio. Here to show you more, it's my pleasure to introduce Iris Nye from National Bank Direct Brokerage.
Thank you, Jared. Hi, everybody. My name is Iris, and I am the Business Development Manager at National Bank Direct Brokerage. So for those of you who don't know who we are, we've been serving direct investing clients for over 30 years. We offer a super competitive and user-friendly platform, and our trading commission is actually one of the best in the industry. So later on in this presentation, we'll talk more about the pricing. So before I start, there's a little disclaimer for you guys to read. So it's basically saying that for self-directed clients, you are responsible for your own investment decisions, and we are not here to give you any advice or any recommendations. So this is our last presentation from National Bank Direct Brokerage. If you've been watching the Larry Berman show, you know that we touched on, a lot of the research section, options, ETF Center, and all the other great stuff. So tonight we will wrap it up with some unique features on our platform that can better enhance your trading experience. Okay, so let's take a look at some of the features that we have here. So you can see on the top right corner, you see the little toolbox. When you click on it, you will see 3 tools that you can access very conveniently. So the first one is compare, and then you have the quick watch list and alerts. We're gonna go to each one of them today. So let's take a look at the compare feature. So this feature allows you to compare up to 4 securities at the same time. Okay, so you can see in this slide, we're comparing Apple, Tesla, Amazon, Snow, and you can see the key quote information side by side. and the performance as well. If you scroll down a little bit on, well, it doesn't show here on the slide, but you can also compare if there are any dividends, right? Their dividend percentage, their amount. If you're comparing ETFs, you can also compare the top 10 holdings as well using the compare button. So there's a little charting icon next to the search bar. If you click that, it brings you to the charts. So you can actually compare the prices, the price charts, just like that. It's very easy to read, very easy to see. And this is the compare feature. The next one is actually the watch list. There you go. Okay, so you can add up to 10 watch lists, and each watch list you can have, 10 stocks or funds that you want to look at. So if you click on favorite, you can favorite one of the 10, and your favorite watch list will always stay on top. Okay, and when you click on the toolbox and you see the quick watch list, you can have a little window open. You can have it open all the time as you are navigating the trading platform. So you can always see your favorite watch. Okay, so in the previous slide, you can see there are different stocks. Inside the watch list in the previous slide, right? So you can easily buy and sell from the symbol, right? And then now you can see right, the symbol, and you can see on the next slide how you can see the target price, right, above or below, the days change in percentage, the percentage change from the 52 weeks range, right? And you can ask the system to send you the alert to your email address. Okay, so the last one here is the charting feature that we did not touch on so far. So if you just want to look at, you can see it under the overview tab. But if you want to customize it, you want to look at the detail of the chart, you can click on expand. So there's a expand button at the top right corner on top of the chart. And you can see on the next slide that you can choose the time frame, right? So in this slide, you can see it's year to date. And the interval you can change to 1 day, 1 week, or 1 month, etc. And you can change it to candle bar if you want. You can also add dividend information or split information here, okay? And what's also cool about this charting system here is you can choose different studies. You can add up to 5 different studies on the chart. So there's MACD, moving average, RSI, etc., volume, right? And on the next slide here, you can see how you can actually use the compare tool as well to compare up to 3 other stocks or securities on the chart, which shows on this next slide. Yep. So you can also draw on the chart as well. So you can feel free to use this to analyze the stock or the ETF if you want. Now let's get to the more exciting part, is the pricing. So for those of you who don't know, we are the only brokerage that offer 0 commission trading on all Canadian and US ETFs. Yes, let me say this again. It's all Canadian and US listed ETFs. It seems too good to be true, but it's true. So as long as you trade over 100 shares, every time you buy or sell, you don't have to pay a commission. Okay, how about non-ETFs? How about stocks? Okay, on next slide here, you can see our pricing is super, super competitive. If you have a bank account, it could be a checking account, savings account, or a line of credit linked to your trading account, instead of trading at $9.95, you can trade at $6.95. If you are under the age of 31, you get 10 free trades a year. And then after the 10 free trades, you only need to pay $4.95. That's right. So it's 10 free trades every year until you turn age 31. For active traders, it's 95 cents. So how do you qualify for as an active trader? You only need to do 100 trades per quarter. Okay, then you can trade stocks at 95 cents. Isn't exciting? What's more exciting is the 200 free trades that I'm about to offer you tonight. If you open an NBDB account, National Bank Direct Brokerage account, this is for new client only. Before December 31st, you get 200 free transactions for your first year. And the free transactions apply to stocks, options, and ETF. Okay, so all of this information will be sent to you, so you don't have to memorize any of that. If you have any questions, feel free to reach out to me, okay, or to our customer service, which shows on the next slide. You have our information, the contact information here. Okay, and last but not least, we are launching a new tool related to options next week. So please be sure to check out our website at nbdb.ca. So stay tuned and stay safe, everybody. I wish you all a Merry Christmas and a Happy New Year. Thank you, everyone. Back to you, Jared.
Thanks very much, Iris. Well, last week I mentioned how when Larry and I first founded ETF Capital Management at the end of 2006, we spent a couple years trying to educate people about what an ETF actually was. Fast forward 14 years later, ETFs have certainly come a long way. And here in Canada, that's thanks in large part to our top sponsor and partner in education, BMO ETFs. Here tonight to pontificate about the evolution of the ETF is the guy who evolved from a Toronto boy to a man who thinks Calgary is in fact the top city in Canada in which to live. He's a director at BMO ETFs, a friend of the show, and goes by the name Rob Butler.
Thanks very much, Jared, and thank you attendees for coming out. I've done a couple of these over the last number of weeks, and we very much appreciate you taking the time to educate yourselves and listen into what we have to deliver to the market. As well, I hope everybody's staying safe and healthy. For those of you who are not familiar with BMO ETFs, we represent roughly 30% of the assets under management now in the Canadian market. And that's with let's call it a 10 to 10 and a half year run in the ETF space. Starting from scratch, BMO has actually been able to accumulate the most new assets in ETFs for 10 years in a row now. So it's been really fun to be a part of that growth. I've been around for about 7 years of it with BMO ETFs, and as Jared suggested, having moved out to Western Canada, and that's where most of my client base and audience is. So it's been a great run thus far. As far as the evolution of ETFs, that is going to be the topic today. And as you well know, there's over 38 different ETF providers you could be working with on any given day. So to say that there's due diligence to be had and you could get lost with all the information coming at you, I do encourage you to spend time doing your research and make sure that whatever solution you do decide to work with, that it's appropriate for your risk profile. As far as the original ETF and what it looked like, the premise behind it was actually institutions that were effectively trading the futures market. And back in the late 80s, upon one of the equity drawdowns or market pullbacks, it was felt that some of the trading in the futures market is what had a negative influence or exacerbated what that drawdown risk was in the equity market. As such, it made sense to create a ticker or a unit that would track a basket of stocks. And the way that you and I know it today, we talk about the S&P 500, the TSX, the Dow Jones. In the early stages, that's all the ETF was. It was effectively a benchmark that held the underlying securities that benchmark referenced. And that's still a huge part of what we talk about every single day. And in terms of delivering that to the market, what clients are concerned with, they want to make sure there's tons of liquidity behind it. They want to make sure that the pricing is very competitive, and which it is across the index-based and benchmark-driven indices. On the next stage, or the next page here, you'll notice that fixed income has also become a very relevant part of what ETFs are in the actual investment world. Now for BMO, it's almost 50% of what we do every day is actually on the fixed income side. It's not just the traditional equity exposure that clients are looking for. Now, for those of you that trade fixed income or have in the past, or even if it's through your advisor or broker, it's really difficult to trade fixed income. Part of it is because it's traded over the counter. It's not traded on a traditional exchange the way that equities are. So that's the first limitation. The other part of that is it makes it less transparent in terms of what the audience, being you and I, feel comfortable with in the fixed income space. It can also be pretty expensive. I mean, assuming you can get access to it, the amount that a trade may have cost us 10 years ago, 50 cents, 1%, 1.5%, just to trade the individual position, let alone get access to it. Whereas ETFs have commoditized that entire limitation, and so many of our advisor base and individual investors are far more comfortable today buying fixed income ETFs that track a particular part of the fixed income universe, and they're able to manage both duration and credit risk in doing so. This presentation isn't designed to talk about currency and cost and everything else that you get to benefit from as an individual investor, but all of this has effectively commoditized what the fixed income universe used to be in a little over 10 years' time. Now, on the next page, when I talked about the first ETF coming to market and that being a benchmark that tracked, actually the first one was launched in Canada, as a matter of fact, back in the early 90s. You can still buy something very similar to what that was. And you can see on this chart here on the far left, we have the word market cap. When we say market cap, we're talking about just that. It's a basket of stocks, and the highest representation within the ETF is going to be the company with the largest market cap. So moving away from more of your basic vanilla type of exposures, we started to move into equally weighted baskets. You can see on your top left corner there, we have the ticker ZEB. That's probably one of the more widely held equally weighted sector products from BMO. A number of players do this. We offer a number of different sectors that you can buy equally weighted exposure to a particular part of the market. And the idea behind that is that you're not getting over concentration or security selection risk because we effectively weight that basket of securities equally. And we'll rotate that basket every 6 months so that you know that you don't actually have to worry about is one particular stock more reflective or more heavily weighted than some other stock based on performance numbers. This is a more diversified, we feel, way to get access to a particular part of the market, and it tends to smooth out the volatility or the behavior of that particular exposure. We then moved into market factor products. Now, market factor, the way we've done it at BMO, and there's a couple different ways you can do it depending on the provider you're working with. We think of factors the same way we do as smart beta, and they're somewhat synonymous with one another. We, in the case of BMO, are talking about dividends, low volatility, value, quality. There's a new number of different ways you can do this, and I'm going to talk in the next page on that. But just to finish off the thought of what the progress of an ETF looks like, we then moved into fundamentally weighted assets, and ZGQ, which is kind of in the bottom middle of that page. That's a traditional fundamentally driven basket. And what's interesting is advisors traditionally use fundamental analysis to determine what a stock portfolio is going to look like. And the premise behind fundamentally weighted ETF is just the same, where we'll look at aspects such as return on equity, year-over-year earnings growth, low leverage, 3-year dividend growth, again, depending on the product that you're looking at. So we derive the portfolio the same way that an active manager does, although we remove the emotional part from that. And then the last piece, multi-factor, you see on the far right. I actually think our dividend covered call products are just that. And all I'm suggesting is that we use 2 different factors to derive the portfolio. And I'm going to talk about that in the next couple of slides. Smart beta and factor-based investing is the combination of traditional active management. So when we think of a traditional active manager, I mean, Larry is very much that. He manages a number of different portfolios for in-house clients and for BMO, and he will do the stock and fixed income selection on his own. Now, on the far left of the diagram in front of you, we have passive investments, which is going to be more traditional S&P 500, TSX, EFI. So nothing's going on there other than pure tracking of that particular basket of securities. Smart beta is kind of in the middle. And what I mean by that is we start with the traditional index to select our stocks, but then we also use an active overlay. Not that we actively manage the portfolio in and of itself, but that we have a very definitive number or list of rules that we follow to determine what the portfolio weightings look like. And through that, that's where we end up with smart beta. So you're effectively getting low cost, traditional passive investments, but with a very definitive objective set to them. And the objective, as I mentioned in the last slide, being dividends, low vol, quality, a number of different variables that need to be appropriate for you and the type of investment that you're trying to achieve. And on the next slide, you will talk about here the multi-factor approach. So when we look at a traditional dividend basket, we're going to be measuring aspects or accounting ratios, looking at 3-year dividend growth. We're going to look at payout ratio. We want to make sure that the dividend's sustainable. We're going to maybe tilt it toward more of a yield-weighted basket. And our team will do that on a set period of time, so semi-annual in the case of our dividend mandate. But then what we've also done with our cash flow products is we run what's called a covered call strategy to be able to enhance the overall income. These tools are incredibly tax efficient. They're designed for clients that are maybe in their retirement years looking for consistent cash flow. But the other two ways I think about these products, I use them myself, and my thought is this: if I can get paid to wait, and people may have heard that expression before, and this was very applicable 6 months ago when US banks, as an example, or Canadian banks were trading down 30% off of their highs back in January. Let's assume I love that asset class, but I don't love the volatility that was coming with it back coming into the middle of COVID, but I do like the consistent cash flow coming off of it. This was a way that you could invest your money, you could choose a particular asset class that you're comfortable with, but also get paid materially more than if you just own the underlying securities themselves. And that's where I use the concept or the thought process of being paid to wait. I'm going to earn cash flow paid out monthly, but I'm also making a call on the underlying security. And I just referenced the US and Canadian banks. And since that time frame, I mean, those have been really, really great tools to be using, knowing that you're clipping a 6 to a 10% in some cases dividend yield, and including capital gains and the option overlay, but you're also getting the traction and the performance of the underlying securities themselves. Now, moving to the most basic tool that we've made available to our client base in the last couple of years, you'll notice Vanguard's up there, iShares. I'm sure there's some other players that have something similar, but I call this my RESP tool. So when I have clients or friends that call me and say, I need to do something for my son or daughter, I'm just looking to tuck money away for a longer period of time, can you give me an inexpensive way to do that without taking unwarranted security risk? And I don't want to have to think about it too much. All we've done here is we've made 3 options available to you that use ETFs as the inputs. The all-in cost is less than 20 basis points. We're going to rebalance that portfolio based on a set ratio based on fixed income and equity. And then it's consistent as far as your geography exposure. We're not making a call on any one sector. We're not making a call on any one currency. All we're trying to do is keep it very consistent and clean, and we want to deliver a payoff profile and performance number that's in line with the traditional conservative, balanced, or growth portfolio. The other one that's not on here that we have launched recently, and I think it's very topical, anyone that follows ESG as a theme, we do offer a balanced version that you see in the middle of that screen, but we do it in an ESG format. You're not giving up anything in performance. All you need to know is that at the end of the day, you can feel comfortable knowing that the asset's being invested within a segment of ESG compliant companies. So there's my 15 minutes. I think I've summarized that last product here. So again, if anybody wants to go a little bit deeper with BMO ETFs, I think I'd recommend as a starting point, BMO ETFs.ca. That's our dashboard. We have hundreds of clients that would use that on a daily basis. Everything you could ever want to know into tax season, product line, updates, strategy, we include everything on that website, and it's very useful. If you have any questions for anything we talked about today, you can access one of your ETF specialists based on where they're located. And again, Rob Butler for the West, feel free to reach out to me with any questions. Now, we're all here to listen to Larry Berman. It doesn't need a huge introduction, but I will say I've done a number of shows. And again, as Jared suggested, we travel across the country rather than do this from our houses, but we will get back to that at some point. The founder of ETF Capital Management, also BNN's Berman Call, incredibly influential in the investment world here in Canada, with both a fundamental and a technical background that he applies to his investment process. With that, I'm going to transition over to Larry Berman, and I hope you have a good show. Thanks for including us.
Thank you, Rob, and thank you, Iris, and to both our sponsors for this great support in the last 10 weeks, and in case of Bank of Montreal, the last 10 years, and National Bank the last few years. We really enjoy working with our partners. Again, the focus of everything I do is really educational. It's the foundation of what Berman's Call was built on. So thank you all too for tuning in every week, and for the wonderful comments, and for those who challenge us, and we're always trying to do better. So, you know, this week's agenda, I want to talk a little bit about some of Biden's administrative picks. I want to, as Jared said, I want to introduce the Pro-Eyes monitor, if you will, our version of the CNN Fear and Greed Index that I talked about last week. I've got a handful of charts to run through this week, and for the next month into January on BNN, each week I'll be introducing another element to the overall sentiment type indicator. And you know, the ETFs that Rob talked about, when we're in an environment like we are now, when the greed element is high, or in our indexes, the complacency readings are high, you want to be more defensive in your portfolio. You don't want to be chasing the news of the day. You want to be battening down the hatches a little bit, so that when the next period of volatility hits, you can sell your defensive holdings and get aggressive again. It's the core element of what asset allocation is all about. I noticed already a lot of questions have come in on gold. I'm going to talk about the seasonality patterns in gold, and reiterate the theory on why I remain very bullish on gold. I want to talk about a new type of balanced strategy that we've launched for our clients that you guys can participate in at home, but really, if you want some help with it, there's help for you, and then our Q&A period. So with that in mind, you know, Janet Yellen as Treasury Secretary, this is a woman that has been involved in just about every aspect of government, you know, from running the central banks to now very likely being the Treasury Secretary, to being economic advisor, to being involved with the Office Management and Budget. Like, she's done it all in Washington, and she clearly gets that the fiscal stimulus is needed for the Fed to do their job in terms of monetary policy. So, you know, market's going to like her. They're going to like her and Powell. And as what it appears to be anyways, that when Powell's term is up next year, like 2022 in January, that Lael Brainerd, who's even more of a dove in terms of yield curve control and money printing, as the replacement for Powell. So it looks like, you know, well into the future, there's going to be a very friendly central bank. That is in a large part the reason for markets, you know, rallying here. It's not fundamental in any stretch of the imagination. Just saw a headline cross the tape not long ago where the Trump administration is the CFO of Huawei that Canada detained. They're coming to a resolution. So I think Biden and what we've heard so far, he's actually going to be a bigger China hawk than Trump was. You're seeing actually tougher talk, but it's very different talk. It's not so much about tariffs and as it is about getting China to understand how to be a better player in the world. So I think you're going to continue to see U.S. very hawkish. One of the things to me that's a no-brainer is for Biden and India and Modi in particular, right, running India, get together because India wants to be the next China in terms of size. They have the people to do it. They have the demographics that China no longer has. China is 43 years old. India is 23 years old on average. Where do you think the growth is coming from over the next 20, 30, 40 years? Right? China is an old economy like North America. It's probably the 5th or 6th oldest economy in the world, and that was largely due to their one-child policy. So China's got some growth problems where India has other issues around growth like inflation, confidence in the currency, and so forth. So that will develop as China's did over the years. So I like India more than I like China from a growth perspective at this point. So Biden's, people he's put in on foreign policy, it's an Obama redux for the most part, and so not wild about that. But Biden is much more of a centrist than Obama. Obama was a lot more left-leaning than Biden is. So I think good in the sense of markets, that he'll govern more from the middle and look for consensus, and really the more progressive part of the party is getting left out again. The Elizabeth Warren, the Bernie Sanders crowd, AOC. There'll be a lot of candy for them in terms of green investment, technology, job development, but they're not going to get the fiscal largesse that they wanted to cut student loan debt and all these other things in the Green New Deal, the big stimulus package that Pelosi passed in May. That's not going to see the light of day. Unless by some miracle that the January 5th Senate runoff in Georgia, both seats go to the Democrats, which is extremely unlikely. Best as I can hear and tell and understand, it's 1-1, but more than likely, the GOP keeps both seats, which gives them a slim majority in the Senate. And as all will know, Pelosi lost, was it 18 seats, something like that? So she has a slim majority in Congress. We're just not going to be able to see radical change under the Biden administration. So that's kind of the summary of what I know so far. There aren't any really controversial picks that are going to have trouble getting approved by Congress for key spots. I follow a firm out of Washington, D.C. called ACG Analytics. They just had a webinar yesterday on it, and that's basically what I just gave you is the summary of what they shared yesterday. So if you want a link there to Brainerd, she's again pushing the button for more fiscal. So I think more support is coming. For that reason, and that reason only, while we'll see corrections along the way in equity markets, the risk of more strength, even though the markets are crazy overvalued, is still probably what's coming. Now, I hate it frankly. The reason the markets are going higher makes me sick to my stomach. But that is the world we live in, and we have to adapt. So that's kind of my top-down big picture look there. So I want to introduce you to the probable return on investment index, the PRO-II. So all the way I approach markets is always about risk and return. Everyone following me on BNN for 14 years now should know that. Someone asked about a stock or an ETF. You know, here's where I'd buy more, here's where I trim. It's never just a yeah, go buy it. It's always in context of risk and return. And when we look at all the indicators that drive markets, to me, it's always about probability. There's no certainty in the world. Every time we make an investment decision, it should be based on risk return, not the emotional side of the decision making. Now, return on investment is key. Everybody wants an ROI when they put $1 at risk. And so the name of the index is actually filtered in. It's got the ROI, it's got the pro, it's got the I's, it's got everything about how I think about markets. So this has been a labor of love for me because, you know, I've talked for years and years on BNN and elsewhere about the Nobel Prize winning work of Kahneman and Tversky, and I'm going to dig into that in the next page here. So it's a multi-factor statistical approach to looking at the confidence interval. So how much is priced in? Are we complacent, in other words? And then when our things are fully discounted. So CNN calls theirs fear and greed. I reviewed all the elements last week about that. I think they're missing a lot of elements that are important. They're included in mine. I'm going to talk about some of them tonight. And as noted, over the next month on BNN, I'm going to introduce some other elements as well. So, you know, in terms of market sentiment, there's the opinion side of sentiment, and then there's the positioning side. So what do people tell us they believe about markets? I'm bullish, I'm bearish. And then how are they positioned? And we can look at some indicators around that. Of course, the VIX, the volatility of markets, very important. Credit spreads, very important. What I call high frequency economics, that's not included in the CNN version, and that, you know, what are the economic indicators telling us, and in particular the leading indexes. So I'll look at that aspect. The yield curve, absent from the CNN model. So the Fed's recession probability index is a big one. Fundamental valuation, not included in the CNN version. I think that is an important aspect of markets that we need to consider. Trend and mean deviation, CNN picks up on those. Market breadth, CNN picks up on those. And speculation and hedging, largely the put-call ratio, which CNN picks up on as well. So there's elements that they don't, there's elements I've included, and I'm going to look at them in a slightly different way that gives us a really good apples to apples comparison. So with that in mind, I want to talk a little bit about Kahneman and Tversky and why this risk return trade-off is so paramount to how we need to think about markets. So Kahneman and Tversky were awarded the Nobel Prize in 2002 for what's called prospect theory. And our level of happiness or greed or whatever you want to call it, our emotional response to the market on the y-axis, our psychological value goes up and down based on our P&L. And what Kahneman and Tversky learned through their psychological testing is that for incremental gains in our portfolio, $100. So for the initial 100, we're pretty excited. We've got a great amount of utility or happiness. For the next $100, the amount of happiness increases at a diminishing rate. By the time we get to $1,000 of profit, our incremental gain on the next 100 is so small that we and that's the complacency aspect of it. It's our emotional response to additional gains that don't get us any more excited. And so we have a diminishing scale. So that's what's termed complacency. But when it comes to the loss side, that initial $100 loss, we feel a hurt. That second $100 loss, there's an incremental hurt, but it never stops. The level of hurt actually keeps rising until we get to the point where we can't take it anymore and we have to sell. But what Kahneman and Tversky proved with their psychological testing, that was for small gains and losses, we dislike the pain about twice as much as we like the gain. And that explains the skew in markets between, markets take a longer time theoretically to go up, and they tend to fall much more rapidly. It's because of that behavior response. So that's core to understanding why and how I look at markets. The emotional cost of investing is far, far greater than the MER. The MER doesn't matter. If you buy an ETF that is 10 basis points or one that's 12, yeah, that's a great selling feature for the product developer. But in effect, if you can't handle the ride, i.e. the volatility of markets, it doesn't matter what that costs. It doesn't matter what it costs you to trade it. You're going to get out. It doesn't matter if it's $9.95 or $4.95, right? So it's the emotional cost that's key. And so identifying when we're in a period where emotion and complacency are at their extreme, this is the time we need to get more defensive. But the type of questions I get tend to be more aggressive, tend to be more of wanting to chase what's working in performance. And I really believe that that's fine, but that's not necessarily the best way we can do it. And it's all about your ability to handle the ride, how much this emotional impact is going to cost. So I encourage everyone to read more about prospect theory. Kahneman, Tversky had passed away many years ago, in the 90s actually. Kahneman wrote a book a few years ago called Thinking Fast and Slow. Highly, highly, highly recommended if you want to understand and learn more about what I would say the correct way or the better way to make decisions about your money. So the PRO-EYES indicator looks for an environment where the probability of what's priced in based on history is at the A+ level, meaning 90% or more confidence interval. And if you understand the basics of statistics and you remember high school math, you'll remember a table that looks like this. So the 90% confidence interval, that 90% of what's in that indicator is already priced in, is already in the price. So if you look at what that means into the confidence interval, how many of those observations, when we're thinking about a Z-score, is under the curve? So in order to get a 97.5% confidence interval, 1.9, and then you look at the 6, so 1.96, roughly 2 standard deviations represents 97.5% confidence. The 90% confidence interval, if you look for where we hit 90%, what you end up seeing there is 1.2, draw the line across to between 0.8 and 0.9. And that's where your 90%. And your 95% confidence interval is at 1.645. and why that matters. That's your Z-score. So what I'm doing with all these indicators is I'm turning them into a statistical confidence interval. And then we're saying, what percentage is that? So it's making it user friendly. So you don't have to worry about standard deviations. What are all those things? We're putting it into a 0 to 100, okay? And that's basically what we're doing here. So a couple weeks ago on BNN, I commented that the American Association of Individual Investors bull-bear sentiment was at an extreme. So here's the indicator over the last couple of years. And basically what I've done here on the right side of the axis is on this graph, and Excel somewhat limited in how it can present here. The bottom half of the graph is between 0 and 100. This indicator's never going to go above 100. It'll go above 2 standard deviations, but that caps the indicator observations at 100. And it's never going to go below 0 because anything below 2 standard deviations in terms of confidence interval is 0. So that's how that confidence interval translates the statistical inference of a Z-score, or how many standard deviations above the normal are we? So the question is, what do we define as normal? So in the indicator of the bull and bear spread, say, well, how many investor are you bullish? And the theory in this indicator, of course, is if you're bullish, you're already positioned, you're already in the market. If you're telling people you're bullish. If you're bearish, you likely have a lot of cash, right? So the difference between the bulls and the bears, if you're neutral, you're in the middle, right? So the difference between the bulls that are probably fully invested and the bears that are probably mostly uninvested, a lot of cash, that tells us how investors are theoretically positioned. And then we can look at things like futures markets, where we have open interest and volume, and we can make an assertion of how people are positioned. Are they too skewed based on history and so forth? So that's another element of the model on sentiment that I'm not looking at right here. This is just opinion. There are a number of different indicators of opinion. Institutional investor, the II survey, that is one of newsletter writers. So every week they survey over 100 newsletter writers and they get their opinion. Are they bullish or bearish? And again, looking for the difference between bulls and bears. But the AAII is adequate. And when that indicator, the net difference goes above 40, that's very extreme. But where we are sitting today and where we were 2 weeks ago, that represented 90% plus. So the vast majority, based on history, this index goes back to 1997, the data here, over 90 is extreme. Okay, and CNN calls it greed. I just, from this indicator, sell high, buy low, right? So when there's a lot of cash and people are not bullish, that's a time to probably be more invested, to think about buying. And when they are telling you they're more invested already, that's the time to be a bit more cautious. So in all these indicators, we're going to weight them to come up with an overall reading of fear and greed, except ours is in fear and greed. We're just calling it complacency and opportunity in our world. The next indicator that I talked about this week on BNN, because it was at an extreme, and I wanted to highlight some of the ones that were more extreme first, was how far are we above the trend, right? So if you're a trend follower, great, the market's going up, follow the trend. But we get to these extremes. And in the case CNN uses the 125-day average, which is basically 6 months of trading. I like the 200-day average because most people look at that as a trend indicator. So how far are we above the trend? So right now, as of today's close, 16.4% above the 200-day average. And you can see here, going back a few years, that blue line is pretty extreme. So now that indicator is at an extreme reading. So we have sentiment, opinion, we have trend, deviation, both very extreme. Our next indicator is what's happening between speculation, i.e. I'm buying a call because I think the markets are going higher, versus hedging, meaning I'm buying a put. I want to protect my portfolio. So what's going on between the call versus put spread, or the ratio of calls to puts? Now, because of things like BMO does covered call writing is pretty natural. There's a natural rate of calls that get done. There isn't a natural rate of puts. So when puts increase relative to calls, that's when people are hedging. When calls increase based on their historical norms compared to puts, that's when people are speculating. So what we've seen in this Robinhood era, if you will, and guys like me telling investors you should think about learning how to use options, is that we've got to pretty extreme readings several times in the last few months, and in the last few weeks in particular, and we're now at readings that are into the 95+% percentile ranking. In other words, pretty extreme based on history. So now we have yet another element of speculation that tells us we're pretty close to an extreme. And the one that CNN is missing, oh, jumped ahead on a page there. The one that CNN is missing is valuation. And there's a number of different ways I look at them. I look at them on enterprise value to EBITDA, price to earnings. Everyone's familiar with the PE, price to sales. There's three ways I look at them. And on all three metrics today, valuation is off the charts extreme. And we're talking about readings of 98, 99%. So, you know, the market, people are positioned for it. They're expecting it. They're telling us they're bullish. They're doing everything to tell us the markets are much closer to an extreme than they are to an area of value. And that just tells us, doesn't mean we have to sell today, but it just tells us that we should be very, very cautious here. The risk of a correction or a pullback is high. What an indicator like this does not tell us, none of them do, is how deep or when that correction is going to happen. But it tells us that if you're in a Z-Grow ETF, that now's a time to go to a Z-BAL or a Z-Con and just get a little bit more conservative with your portfolio. Not be so concerned with chasing momentum here. That doesn't mean the markets can't keep melting up, for the simple principle that markets can stay in these extreme irrational states far longer than you can imagine sometimes. And then sometimes it corrects very soon. So that element of timing, you know, folks, when I figure that piece out, I'll be sure not to tell anybody, because not that I don't want to share, but that is the thing. Bottoms relative to tops are pretty darn easy because of that extreme pessimism, that panic. You know, in March, even though I thought valuations were still not cheap and we could go a lot lower, I talked about that in the spring series, you'll all recall, that bottoms are relatively easy compared to tops. Tops are very, very, very difficult. But the message now is to be conservative, not aggressive. Okay, so that's it for the pro eyes at the moment, and there'll be more coming out on my show. I didn't want to release everything, all the indicators tonight. I wanted to leave a few for the coming weeks for our BNN audience as well, which I know many of you certainly are. I wanted to talk about gold. A lot of questions on gold. For those of you who are written in, I'm not going to answer your specific question. I'm going to give you my thesis on gold. So what I've created here for the last 10 years is a seasonality bubble chart that looks at, it's like a heat map, I guess you can call it a heat map. It actually, Bloomberg calls it a heat map. The greener, the brighter it is, the bigger it is, the redder, the brighter it is, the more negative it is. And the difference between GLD ETF, the gold bullion, and then the gold miners GDX. And both of them really for December, January, and February have very, very positive seasonals over the last decade. And you can go back, you know, if the ETFs were around 20, 30 years ago, the seasonal patterns are still very, very similar. But for the next few months, the seasonals are very, very compelling. So 'tis the season for lots of things, but gold has very positive seasonals for the next couple of months. But that's not the reason you go out and buy it today. The two major driving factors are the negative real interest rates. So interest rates adjusted for inflation, and that's the red line. And in the last few weeks, we've seen this divergence, that red line starting to trend higher again, where gold prices and gold stocks are breaking down. Now, my best understanding is that there was a hedge fund being redeemed. Some of their biggest positions were in gold, and there was some forced liquidation. And it broke some support levels, 1850, then it broke the 200 for gold bullion, and those of you who follow it will have seen those breaks on the charts. Same for GDX, it causes people to panic. It invokes prospect theory. I get questions like we have tonight. Should I be selling? What's going on? I own a lot of gold. Help me out here. The reason you own gold is because of this chart. It's because inflation is being more accepted by the central bank, and in order to keep the economy going, they need to keep interest rates down. You're going to have that red line stay negative and continue to increase negative. They're going to have to buy bonds to do that. They're going to have to stimulate. They're going to have to keep real yields. They're welcoming inflation, which is going to push that red line more negative. At the same time, they want a weaker US dollar index. All these things are firing bullish. Gold is going higher, guys. So don't worry about the volatility. Don't be shaken out by the noise. Understand why you're owning gold and gold equities, notwithstanding seasonal trends and corrections that are inevitable. That's part of trading. I'm not happy the last 3 or 4 months. Gold is the biggest position in all my portfolios, but now it's starting to work again. And for the next few months, we have very strong seasonals. I'll get concerned again sometime in February and March, especially if the Fed gives any indication whatsoever that they're going to back away from some of the debt monetization and stimulus. And if they start to say that, then you know we cut the position in half into strength, kind of thing. So that's the story for gold. And I'm sticking to it until I see a reason not to. And the biggest negative for gold will be to see the Fed change their view on inflation and talk about taking away accommodation. I can't see that for the next 2 years minimum. Okay, so now all this negative rates, all this extremeness in equity markets has made the 60-40 portfolio, the guaranteed yield, so the dividend plus the yield on the bond in a balanced portfolio, it's a problem for every pension fund and every retiree on the planet. It's why I get questions about all these kind of things. So for our clients, we've launched 2 new funds. Unfortunately, they're not available publicly. Maybe they will be one day. But we're focusing on different ways of generating that safe yield. So one of them is in real estate and infrastructure. Now, these are areas where if you're working with experts, like a Brookfield, for an example, these guys do a tremendous job in the private equity and debt space, lending to people who need the money that banks won't lend to, that can generate cash flows that every pension fund wants. Except when you buy a Brookfield, or when you buy a REIT, or when you buy a mortgage, a public MIC, a mortgage investment corp. So I created an index going back 10 years with the blue line, and that is exposure to public markets in real estate and infrastructure, compared to a basket of the companies that we work with that are in the private lending market and what their funds have done, and that's the red line. That's just an equal weighted exposure to a basket of 10 of the best private debt equity managers in Canada. And we own units. Now, some of them are for accredited investors. You've got to have the $1 million. Your minimum investment needs to be, $250,000. They lock your money up sometimes for months or years. You can't get it out. And so that's the challenge with the private market. So what we've done for our clients is take this basket that has a 6% or higher yield to it all the time, that has a public part so that we get a little bit of volatility, but we're still able to generate that 6% plus that the average pensioner, pension fund retiree needs. And what I've done is I've combined that with a ZPay type portfolio where we find companies we want to own today, and we buy them and we write calls on them to generate an extra 6% in yield through those calls. When the stocks go up and they get called away, we write puts to buy the companies we want to own, always generating a 6% yield. So now I've got a debt side with low volatility that pays me 6% or more. I've got an equity side that on average is going to be half exposed to the stock market, long covered call. And when it goes up, I'm going to sell. And when it goes down, I'm going to buy. I like that. It's got a third of the volatility of the equity markets and 2 to 3 times the yield, right? So you can use ZPay for that. That's why I've been fist pounding to you folks for all year since BMO came out with that product, and why I use it in my funds for BMO. It's a fantastic product. It's great. It's fantastic. But right now there's no great solution on the debt side. So we have one for our clients, and if that's something you're interested in, by all means, reach out to us. We'll be glad to show you what we can do for you there. But what you're going to see in 2021 and beyond. Now, I did a TV show with Mackenzie funds, and Mackenzie as ETFs. Mackenzie just bought or did a strategic alliance with one of the really good private debt managers that we're involved with too, Northleaf. We did a whole TV show, and I think they broadcast it on BNN. Was it last week or the week before? And they're going to come out with funds. So you're going to see a lot of funds come out They're going to cost 1.5 or 2% or something like that. But they're going to offer you that ability to get that, replace that fixed income yield. That, folks, is going to be the next biggest growth area in investment products, is to replace that fixed income yield that no longer exists, that it's negative and it's causing all the problems in the world. But it is the sole reason. We don't have a good economy. The sole reason for stock multiples going up the way they have is because money is cheap. There is no alternative. That's not a reason to be bullish, but that is a reason for multiples to maintain a higher level. What kills this all? What kills everything here is the central banks wanting more inflation and not keeping yields low. And that is going to create a period of stagflation down the road. Whether it's 2 years, 5 years, I don't know, but it's coming. That is going to kill equity markets at some point. So a policy mistake by the central banks or a period of stagflation, which is going to be a big hit to margins for corporations. So that's down the road, a couple years. I don't know, but those are some of my thoughts. Just to reiterate here again, where is the investment of the future? It's clearly technology. Again, this is the shopping list that I've had out all year, basically. And a lot of these things are very, very expensive. Some of them, not all of them, have options. So you can keep writing puts on some of these until they get to the price you want to buy them at and generate a yield doing it that way. So lots of opportunity, folks, in terms of alternative ways. And I think we do need to think alternatively in this crazy world we live in. So next year, we're going to be on our YouTube channel, come out with an option, option 101 series, 201, that kind of thing that we did with ETFs this year. So we're in the process of looking for a sponsor for that. And I think we're getting close there. So, all our educational content, again, going forward, follow us on the YouTube channel for that. So into the question and answer period. This week, I'm going to handle the online ones first because we didn't get to those last week, and then I'll get to the ones that people wrote in on. I've answered a few of them. James was asking about an ETF that plays emerging markets, excluding China. And maybe you heard my comments on China. Maybe James believes that China is going to underperform, as I do. EMXC that trades in New York is emerging markets ex-China. Have a look at that one if that theme makes some sense to you. Questions on bullion. I've made my comments on gold. I'm not going to answer those specific ones. I do want to bring up a graphic here. Someone's asking me about Bitcoin or GBTC. So XBT is the underlying Bitcoin price. So I actually don't think I looked at a chart today. I did comment about the crazy nature of Bitcoin and the speculative nature, and that I think it's worth close to zero. But you are going to see at some point, I don't know when, this thing, easily back to 12,000, if not 10,000. The question is, does it go to 20,000 first? And the answer is, I don't know. So Bitcoin to me is a speculative vehicle, no more, no less, that can be traded, that has 5 times the volatility of anything else on the planet. And if that's something you want to trade, by all means, it's not investable. It's not investable because what we know from Kahneman and Tversky is you'll get shaken out at some point. The average person's not going to be able to handle the volatility that Bitcoin goes through from time to time, over and over and over again. But the bulls will tell you, don't worry about it, just keep buying it. Well, that's what they want to, because it is a Ponzi scheme after all. It's basic economics. In theory, it's a limited supply of an asset. And as demand goes up relative to supply, we know price goes up. That's the fundamental basics of economics. If that's what you want to trade and put your money in, I mean, more and more institutions are talking about including Bitcoin in their universe. This is the problem with interest rates at zero. There are no alternatives. People are looking at this stuff. But I'll tell you what, you know, if Canada Pension tells me they're going to put money in Bitcoin, I'm leaving Canada. This is a speculation. I can't underscore that enough. Doesn't mean you can't play it. That's a different thing. So if you're okay with speculation, by all means, GBTC is a vehicle for doing that. Sean is asking, he's saying, Larry, my mouse stopped working here. So give me a sec. Says, Larry, do you believe we are seeing a shift in fiscal paradigm? Is there anything you would consider of interest outside of gold and base metals in terms of fiscal spending? Well, you know, where is that money going to get spent? So how does it get spent? So if they're giving money to consumers by way of fiscal largesse, you know, interestingly enough, this recession, this is the first time we've had a recession in the history of recessions where incomes for individuals actually went up with job loss. Never happened before. In fact, there was so much fiscal largesse and support for individuals that incomes rose more than had COVID never happened and they had kept their jobs. That's how overboard governments went. And it's absolutely crazy. Now, to my detriment, I missed, you know, the impact of the size of the largesse in terms of its impact on economic numbers and the consumer's ability and willingness to spend that money. And now we've got vaccines in sight. We've got herd immunity, hopefully end of next year. Someone asked if we're going to go back to road shows. The answer is yes. As soon as our average viewer, our average person on this webinar who's 60 plus years old is willing to go back to theater, I can get on an airplane and not worry about getting COVID, then I say, yeah, let's get back on the road. I love doing the shows, but for now, probably for sure in the spring, probably next fall, these are going to be virtual. But you'll remember we've done a webinar at the conclusion for all the people that couldn't come out to the live events. So we're always going to do a webinar version of the road shows, but to me, nothing replaces seeing people live, the live question, the feedback from the audience. It's just not quite the same in a webinar format. Is there anything else though that you know, to answer Sean's question that I would, you know, invest in? And usually it's the cyclicals. It's the aspects of the economy that are going to benefit more from spending, industrial cyclicals, consumer cyclicals. You know, if it was a Trump administration, more spending on military, more spending on, so that those tend to, but that under a Biden government, that's not an area you want to spend in. So, you know, a broad blanket industrial is probably not as good because it includes a lot of the military contractors. And so, those are some of the things you got to think about. When you buy the XLY, the broad-based consumer cyclical, you get a big part of Amazon, right? And it's a huge part of it. And is Amazon, yeah, they're priced for perfection here. So I think more of a correction before a rally. So that'll be a bit of a headwind there. I still think gold is wildly attractive, and base metals are your best ways to play those. How can we get the presentations after the seminar? YouTube channel. If you fill out the feedback form that you'll get tomorrow or sometime later tonight, that will give you access to the PDF version of the slide deck. So hopefully, Sat Binning, that answers your question. Donna is saying, what's the likelihood for effective vaccines coming in the next few months, with the likelihood of being a high probability? So Pfizer announced today, I don't know if you saw it just before the close, they're only going to be able to deliver half the amount of vaccines this year that they expected to, because of supply chain and the challenge with distributing their product in a sub-zero world temperature. So the Pfizer stock sold off a little bit. Moderna's rallied. There's going to be supply chain and distribution challenges to the vaccine. The stimulus and the monetization of that new debt that is needed to fund the stimulus, that is the bullish time for gold. So I did comment on gold. Why is ZPay not included in my buy list? Because that was more of a technology buy list, not a yield play, and that's why it wasn't on that list. Okay. Is the webinar recorded for viewing? Yes, Sylviana. Watch it on the YouTube channel. How do you submit a question for Larry? Well, that you just did, Dean, by writing, how do I submit a question for Larry? So if you have another one, write it in the box like you just did, and I'm going to see it on my desktop. But when we send out the notice of these events, there was a, if you have a question, click here box, so you could send us an email question, which many people did. Is there a copper mining, is there any copper mining in Canada that you can recommend? So if we look at COPX, this is the COPX. This is the copper mining ETF, the big global one. And if we look at the ETF and the holdings, and we look at Canadian holdings, so I'm going to just change the view here to look at currency by sector. Should take about 30 seconds or so to filter. Hopefully, as this is filtering, the Canada does have a couple of very good plays here. So Canadian dollar, materials sector. So these are all Canadian listed plays. And if you sort by weight, you can see that First Quantum is probably the biggest way to play it, followed by Hudbay and then Ivanhoe. And Lundin would be another one. Now, a lot of them aren't just copper, they're broader plays, but a big component of them is copper. Teck is not a huge copper player. They do have copper, but they're known for their metallurgical coal, basically, for building steel. So that wouldn't be the one I would go to there. But COPX is a great ETF in the States to play copper miners. Riza, how do you see the Canadian US dollar over the next year? Basically, we're I think fundamentally we should be closer to 140. I don't think we're going to see that. At the moment, the Canadian dollar is caught up in the reflation trade, the rebound in oil prices, the euro weakness, and so the overall dollar weakness. So I think in the next few months, 127 currency traded, that takes us up to about probably 78.5, 79 cents. 125 is 80 cents. That would be the extreme. 135 the other way around, so around 73 cents on the other side. That's probably the range for the next year. What happens if the media has got Trump claims wrong, like the suitcases of votes under tables on cameras? Are we able to talk about this, or is it taboo? Say he wins. What do you think happens to the markets? Kirk, Trump lost. There's no scenario here where Trump wins. The certification will be December 14th. So until the certification, we don't know. But 99.99%. Listen, if there was some kind of change, I just don't see it. I'm sorry, Kurt. I can't go with that. Larry, why does it make you sick to your stomach to see what the market is doing? I'm not sick to my stomach to see what the market is doing. Markets going up are fine. The cause of markets going up, money printing, this is not stable. This is failed economic policy, right? I'm a free marketer. I want zero government other than policing us, putting people in prison when they need to, military protection, some of the basics. We need government to get rid of our trash. We need healthcare, certain basics. Okay, that's, I think, government's role. Capitalism is gone. We can no longer price assets correctly because of the intervention. That's the part that makes me sick. Okay, so Franco, I hope I'm clear on that message. Markets going up is great. Asset prices rising. The problem is the moral hazard and the instability and the volatility that's going to come with all these fake or false reasons why the market value is going up. Okay, so I hope you understand that, Franco. I heard that it's not a good idea to buy mutual funds or ETFs at the end of the year because of the nature. Because of the nature of fund distributions. So that is true for mutual funds. You have embedded gains on the year, and then you get the distribution. So you get the tax hit, but you don't get the benefit. That's true for mutual funds. ETFs don't work that way. ETFs taxability is on, and that's why they say they're more tax efficient vehicles, is based on when you buy and sell the ETF. So if you bought it in December and the year-end distribution to clear out the trust value so the fund isn't taxable, if there's income, that needs to be paid. But an ETF just tracks an index. There's not a lot of buying it. So the active ETFs have some of that issue, but the passive ETFs that track an index do not have that issue. Okay? Active mutual funds have that issue. If they're buying and selling a lot, they generate capital gains that are realized. And if you buy it at the end of the year, you get the tax hit from that, not the benefit from it. So great question, Alex. ZPay would be one of those ETFs that when things get called away, it generates a capital gain and there would be a distribution, except that they're paying out that distribution already monthly. So at the end of the year, that gain, that distribution, 6% of it's already been paid out. There's not much left. So I don't know the math. There'd probably be a little bit of year-end distribution there, but not that much in a ZPay because they're paying it out monthly as they go. Okay, so great question, Alex. Apparently, there's so much cash on the sidelines, yet bullishness in the equity markets is at an extreme level. How is this possible? The cash on the sidelines, it's true. There's been a lot of redemptions. The cash on the sideline is not money that's probably ever coming back to stocks until valuation is better. Warren Buffett has 150 billion in cash in Berkshire Hathaway because he doesn't see value. He's not caught up by fear of missing out. Okay, he doesn't do that. So he's got cash for opportunity and value, and he'll invest it in other things to generate an income from it. That's less than other things he could earn, but until there's value, he's not going to put that money to work. That's different than mom and pop retail, seeing the markets going higher and having cash and wanting to participate. That is Kahneman and Tversky, and please read Thinking Fast and Slow. So how do you spell Kahneman? K-H-A-N K-E-M-A-N, Kahneman. Tversky, T-V-E-R-S-K-Y. Tversky didn't author the book, but did a lot of the psychological work with Kahneman in the 70s, 80s, and 90s. I believe Tversky passed away in 96. The Nobel Prize was awarded in 2002, and they don't award it posthumously, so it was just awarded to Kahneman. Lots of great online questions tonight, so thanks a lot for those. If most of the growth in the future will be in emerging countries such as India, wouldn't that be bullish for oil as opposed to EV? The biggest growth in EV cars and the biggest growth for Tesla is coming from China. China and India both have catastrophic environmental challenges, and their pushback to the developed world was, well, you guys did this in the 50s, 60s, and 70s while you were industrializing, and we didn't until the last few years. So pardon us for burning coal. You guys burned it a long time ago. That's the argument that comes out of China and India. And frankly, you can't fight that argument. They have a valid point. So until their economies get to the point where wages and GDP is equal to developed world status, which, you know, China's been at that for 35 years now since Mao and the reforms. And their GDP per capita is still, you know, 25% of the U.S. And in India, it's probably 15% of the U.S. GDP per capita. So they've got a long way to go. I think technology solves a lot of the cost issues because, you know, if you remember a decade, 15 years ago, solar panels were starting to come out, and that was, you know, wind. And the cost of a solar panel 15 years ago versus the cost today, the cost of a unit that they use to frack oil that goes underground to crack and inject the gas and everything they do to do fracking, that used to cost, I don't know, $2 million and take 20 people to run. And today that same technology costs $2.5 million, but it needs 5 people to run. That's productivity enhancement, right? So it's those things that are going to make EV available to the mass markets. And it's not going to take long. You'd be very surprised. Why does gold fall each time? Well, I talked about gold, but here's why does gold fall each time a vaccine is announced? Because it's thought that we're going to need less stimulus, less Fed, less negative real rates, that kind of thing. So there's a direct impact on reopening versus flight to safety versus negative real yields. Folks, it's 8:30. I probably have another hour worth of questions that I didn't get to all of them. Last one here, Paul's asking the best ETF to invest in India. BMO has a ZID. I think iShares has their version. It might be XID. I'm not 100% sure on that. INDA in the US. There's a number of good ones. If you want to play, Invesco has PIN, Small Cap India, SMIN, Top 50 Stocks in India, INDY. So lots of great ways to play them. I think, you know, it's an area that you want to be in. Small caps are particularly interesting to me in India. So thank you, everybody. You know, really thrilled that we get so many great questions. And again, if you can find it in your heart this time of year to dig deep and support either cancer research at the Sick Kids Foundation or dementia and Alzheimer's research through the Baycrest Hospital and Foundation. You know, Jared and I would be thrilled to match it this time of year, especially. And if we've made you a nickel or a dime, you know, please share that with these great charities. Thank you so much, everybody. Looking forward to the holiday season. We'll be back in March with another virtual road show. In the meantime, stay tuned on our BERMAN'S Call show and on our YouTube channel. Be well, everybody. Be safe. It's going to be a difficult few months, but we can see the light at the end of the tunnel. Thank you so much, everybody. Be well and be safe.